Our next question will come from George Kauss.
Mayor and Council, thank you for allowing us the opportunity to ask these questions. It's very important for our community. I'm going to detour just a little bit from my prepared questions. You handled one previously. I know you can handle this one too, because it was your answer that caught my ear. Gas. Gas today can be bought at under $4 a million cubic feet. And I believe you said long-term contracts could not be entered into, but I know that long-term contracts can be entered into, especially in the case of power plants. And today I think they're in the $6 range or a little bit cheaper. So why are we choosing nuclear over the gas option exactly? That's the first part of my question. The second part is, Julian answered this a little bit, but why do we have to be owners of this plant? Why can't we just do a power purchase agreement which allows the developers to go out and get funding, especially with an organization as strong as CPS, so they can go out and get their funding, but we don't have to carry the development and ownership risk in this plant.
Okay, thank you, Mr. Kauss, for that question. Yeah, the first part of your question is why not natural gas? And the answer to that question is the short-term price for natural gas really doesn't factor into this decision, because the plant that we're looking at wouldn't come online until 2016, 2018. So it's really important what the gas price is from that point going forward. If you look far out onto the gas price forecast, there's a number of them now that are out there. The prices start in the mid 6s, 7s, and they escalate on up from there. So really over the life of the plant, we expect energy from a natural gas-fired power plant to still cost 10.5 cents a kilowatt hour versus 8 to 8.5 cents a kilowatt hour for nuclear. So it has a big part of the answer to your question is today's gas prices really don't factor in. It's really the long-term gas prices, which are still relatively high. Now regarding why don't we go out and do a PPA, a purchase power agreement from the output of the nuclear plant and let somebody else, maybe like our partner or other partners, go forward and build the project. And there's a couple of reasons why that's not really in the best interest of CPS customers long term. Number one is that building, owning, and operating the power plant is always going to be cheaper than buying the power on a fixed price basis long term. That's because the developer that develops that project is going to have to factor in the same risk premium that we would, okay, but they're also going to have to factor in profit. So we'd have to pay for the developer's profit. We'd also have to pay a we'd have to pay a different price for financing. CPS Energy, because of our good credit rating, and because we're municipally owned, we can borrow at tax-exempt financing rates, which we're forecasting to be 5 to 6% interest over the life of this project, as opposed to a private developer that had to borrow at rates considerably higher, 8%, 9%, 10%. So we're talking about hundreds of millions of dollars of additional costs on a project like this. So then there's also credit risk. If you have a PPA, all you've really done is you've converted project risk to credit risk. So now you have somebody who's promising to deliver the power, but what happens when they go bankrupt? You're still exposed at that point to market price power because you have to go buy it somewhere else. So you're just trading one risk for another. The PPA doesn't eliminate the risk, it's just trading it for a different kind of risk. And then finally, PPAs give up the long-term asset value. Okay, so a purchase power agreement may last for 20 years or maybe 30 years, but this asset is going to last for 60 years, probably even longer. It's being designed for 60 years. So if we went the purchase power route, then we would basically lease that project through the purchase power agreement, and at the end of the purchase power agreement, then we have nothing, and we have to go out and get another purchase power agreement. Meanwhile, the owner of the project that we've helped pay for through our purchase power agreement, they own the asset, and it's only half of its useful life old. So that's a significant benefit. It's hard because of the discounting involved on net present value to take that into account. But this project actually has water rights for the life of the project, not for a fixed amount of time, but for the life of the project. So this would be a good project to hold on to for that reason, to own for a longer period of time.
Let me get back to the gas real quickly, and then I've got just the second part of the follow-up. It was my impression that you could enter into 20, 30-year gas purchase agreements and set the price today. So the price in 10 years from now when our power is needed may not be the price that we're paying if we enter into the agreement to it today. Maybe you could answer that. Secondly, what protection do we have, assuming that the gas goes away and it is nuclear and we do own part of it, that we aren't naked to the costs of cost overruns of these plants? Historically, the cost overruns have been wild. The cost projections have been wildly inaccurate. We're a little bit better at it today. This would be the first one built in the United States.
Yes.
So are they prepared to guarantee the cost of the contract? And at what point Are they prepared to guarantee that? And what fallback position do we have if we don't like that price?
Okay, first off, we can contract for natural gas 20 years out. If you contract for it at a fixed price, you still have the credit risk. And that's essentially what we went through in the 1970s with Oscar Wyatt. He promised a fixed price, ultimately couldn't deliver and had to break the contract. If you can contract for it on a floating price, but that doesn't get what you're after. So you can do that, but you still have credit risk, okay? Now, regarding the cost overruns, Toshiba, in fact, we selected Toshiba because they are willing to take the risk of, after we get to the point of 95% engineering complete and we get the license to build the plant in 2012, that's when they will give us a fixed price. When they have all the design done, which is one of the problems in the 1970s, contracts were awarded when there was only 20% or 30% engineering completed. This time, we're working with Toshiba to have 95% of the engineering complete on this project. And this is a project that I've said before, they built 3 times in Japan. So this is not a brand new design. It is, in fact, in a brand new country, and therein lies some of the risk. How are we going to Americanize the project from Japan?
Great. Thank you very much. Thank you, Councilman.
Thanks.